Many of you guys don't. I'm going to encourage you to pick it up. It's not a webinar to sell books, but if you haven't read it, it's a really good book when it comes to creating tax-free generational wealth. But strangely enough, most of the information in that book we're not going to talk about tonight. We're going to talk about totally different stuff that's not even in that book. So I'm very excited about that. I've been in business of real estate and finance and marketing for about 24 years. I started as a kid. That picture you see there, I'm about the same size, but that's about 8 or 9 years ago. So unfortunately, I've got some more white hair has come into the picture, so I need to get some new pictures taken. But for better or worse, that's me. We do business nationwide. In fact, most of my clients are not local to me. I happen to live in Detroit, Michigan, cash flow capital of the world for you real estate investors. But most of my clients are nationwide. Most of my clients are not local. And I bring that out to you because you know, the internet has made things very accessible to do business with anyone we want, almost any place we want. And I'm very excited about that. So I get to bring information nationwide to people. I get to do it. You guys are probably sitting in your pajamas and bunny slippers, and I'm sitting in about the same. So I'm very excited to have national clients. And I will hopefully going to work with a lot of you guys here that are on this call tonight when you see kind of what we do. All right. So even if you're on the other side of the country, doesn't mean we can't do business together. Chances are I've got clients in your state. I already told you I'm the author of the #1 bestseller, The Perpetual Wealth System. Also, Wealth Without Stocks or Mutual Funds coming very soon. You guys will know when it comes out. And I've been a national speaker, author, a money and business strategist. I've been fortunate to teach in every major city throughout the country, and really enjoy teaching people. And really, that's what we are first. Yes, we do sell financial products, but before we sell them, you know, we educate people, and we really show people how money works and how these specific products work and how they can work together. And sometimes it takes a long time for people to actually do business with us, and we're okay with that because my best client is an educated client. If I've got an educated client, they're probably not going anywhere for an awful long time because they really understand what they're doing and why they're doing it. And that's why we put on these events. I'm really excited to put this one on. We're going to be having some other ones in the near future as well. This is one of my clients that's about 800 miles away from me, and he was very, very kind to give me a very nice testimonial. If you guys want to do a little bit more research about me, of course, you can always Google. You probably maybe you've already done that. You can also go to my websites, which I'll give you at the end. A lot of you guys have already been there. You can get testimonials, see videos of me, those kind of things. So if you want to get an idea of kind of a little bit more of who I am, and if you decide you want to do business with me, that's great. I do want to tell you tonight, I have nothing to sell you tonight. So at the end, there's not going to be any pitch to buy a package or anything like that. I'm not saying I never do those, but that's just not what tonight's about. Tonight is 100% about education to see if I'm going to be a fit to help you and your family create wealth. So again, this is going to be one of the series of training events. And one of the questions you need to ask yourself is, do you really know how much income you need for your retirement? How much monthly income do you need to either maintain your lifestyle or at least have a lifestyle that you're excited about? And most people, most clients, when I ask them that beginning question, they really don't know. They can ballpark it. They have to think for a while. So when we get off this call tonight, I want you to spend a little bit of time and say, all right, how much income would I need? And of course, that's going to depend on when you retire, how far you off, are you already retired? How much monthly income do you need your assets to produce? All right. So that's the first question I want you to ask yourself. Once you have a figure, do you know where that income will come from and in what amounts? And again, if people have that figure, almost nobody knows where that figure is going to come from. Now, of course, there's Social Security. We're going to talk a little bit about that. Some people still have old-style pensions. But for the most part, people have retirement accounts, and there could be 401ks, IRAs, any of the above. And they might know how much money they have in there. Some might even know if it's performing or it's not performing, but they really have no idea how much income they can generate out of there for their lifetime. So I'm going to help you with that tonight. And another question is, could you or your spouse outlive your money? If you do get retired, will you have to go back to work? And that's something I don't want to have happen to anybody. Guys, as you walk into, Lowe's, Home Depot, whatever it is, and you see an older person working, if that person's working because they love it and they really like being around people and they want to contribute to society, I'm all for it. I have no doubt that I'll be doing something till they lay me in the grave, hopefully when I'm very old and very gray. But I want people to do that because they want to, not because they have to. And when you see someone of a little bit older age working really, really hard for not a whole bunch of money, most of the time it's not because they want to, it's because they have to. And so we want to avoid that for you, and we want to show you guys how to get retired and stay retired. All right. Another question is, would you like to make sure you never lose a dime of money in the next market collapse? And I say the next market collapse as we are record highs with almost all the indexes, and I understand all that. And it's almost like people have forgotten 1999, 2001, 2007. You remember the times when you didn't even want to open up your retirement account statements? You didn't want to know what you had because it was so brutal that people were down 30, 40, 50. Sometimes I saw 70% losses. And it doesn't need to be that way. There's other things we can do that we don't have to be in mutual funds and in stocks. And I'm going to give you guys some ideas on what you could do with some retirement money this evening that will grow it and protect it. So, but ask yourself the question, hey, how would it be if I never lost any money in the stock market again? It's going to help you retire, and I can help you do that. So what are we going to talk about tonight? I'm going to show you that many of you, your finances in retirement are in serious trouble. But I'm going to show you how to reposition assets to be able to get them on a path that they're not going to be in trouble. All right? So we want to show you what a retirement danger zone is. I want to talk about it a little bit. A retirement danger zone is basically this. If you're already retired, or if you plan on retiring in the next few years, or within the next 10 years, that's all considered a retirement danger zone because any big market losses at any point during that time, especially after you've retired, but if you're just ready to retire and the market tanks, or even 10 years from now, who knows how long it would take to get that money back, and it can dramatically affect the timing of your retirement and the lifestyle in your retirement. So, we want to show you that if you're in that retirement danger zone, you really need to start rethinking how you have assets positioned. And you want to do it now because the market is high. I'm going to show you how to capture these market highs that hopefully you guys have been able to participate in if you're in the stock market, how to capture them and then never give them back. Never have to give them back to any market losses. I'm going to show you why mutual funds are a lousy place to retire in. Mutual funds are, in my opinion, they're a lousy place to invest in. But I do understand that people have done well with them. Some people love them, and I get that. But that maybe is open for argument. But to retire out of them, to have your money in mutual funds when you go to retire is just not the place to be. And I'm going to prove that to you tonight because market losses can absolutely devastate your retirement. So we're going to show you how to reposition to get prepared for retirement, to really reposition your assets. Everything changes in life as we get older. Our situation changes, our bodies change, everything changes, and yet what I notice is a lot of people don't ever really change their money plan. Well, your money plan needs to change as well. All right? I want to make sure that you're not forced back into the workforce after you're retired unless you want to be there. You're choosing to be there because you love it, you're contributing to society, you want to be around people. I'm all for it, but not because you need to be, and we can make that happen. The fact is millions are unprepared financially for retirement and have their funds in the absolute wrong place at the wrong time. Many people still have their money in vehicles that they had them in when they were in their 30s and 40s and early 50s. Okay? As you get to be in your 50s, 60s, 70s, 80s, and beyond, your money needs to change. It can't be in the same places because you need it to do different things than it needs to do when you're in your 30s, 40s, and possibly even your early 50s. All right? By not repositioning your money, it can cause a huge change in your retirement dreams. As I say, right now the market's high, and some people have short memories, or maybe they weren't even in the market back when it tanked, basically 3 big times over the last 15 years. And a lot of people don't even remember that, or they're choosing not to remember. And we need to make it clear to you tonight, guys, that that kind of stuff does happen, and it can happen. We've got record price-to-earnings ratios. We've got very unstable economies. We've got the stock market now much more volatility than it's had in the last quite a few years. So it's not a question of if the market's going to go down. It's when and how much and how often. Because it's definitely, you can definitely look at history and know that it goes down and it goes up. The problem is if you time it wrong, and the stock market's definitely a creature of timing, if you time it wrong, it can cost you your money. And we don't want to have that happen. So ask yourself a question. What would happen to your retirement years if your nest egg lost 50% of its value, and it did it within the next year or two? What would happen? And that's not out to scare you. It's just out to say, hey, this has happened 3 times in the last 15 years. And it can happen again and probably will happen again. You just need to be prepared for it. So you need to understand that you would live a lot differently if you didn't have 50% of your nest. Yet as I talk to people who are in their retirement zone, or retirement danger zone, almost all their money is in stocks and mutual funds, and it's just not the place to be. Last thing to think about, are you at all prepared for long-term care or home health care needs? Now, some people choose to buy policies for that, insurance policy. Some people on the call have those. I'm really not even talking about this. I want to share with you guys that I teach a concept called the 5 circles of wealth. And one of those circles is called long-term care for retirement, because that is the only circle of all the other circles that can devour the rest of your estate. And the plan that most people have for it is hope. They hope they don't get ill. They hope they're not going to be extended sickness for a long period of time, and hope's not a plan. I want to give you guys some alternatives to expensive long-term care policies that may give you some assistance and actually supplement should you ever need long-term care or even home health care. If you need somebody to come in to help you perform certain tasks, there's things that we can set up that's called asset-based long-term care and asset-based home health care that doesn't require an expensive insurance policy, and we might be able to accomplish almost the same thing. So are you prepared for long-term care at all? And if you're hoping that you're not going to get sick, or I've been healthy my whole life, it doesn't matter. Things change, as we know, at the drop of a hat. Now, one of the things I want to share with you is this is an interesting little chart here, and it's called sequence of returns. And it sounds very fancy, but it's really not. It just is telling you that it matters when you gain and lose money. So if you look at this example, these two columns, both of them are going to start at $500,000. You're going to take income out at 5% of the first year principal balance in both columns. They're going to figure an inflation rate. I have a thing. I can see the screen but did not have audio. Call into the phone number. Call into the phone number. Okay? Call into the phone number. All right, so it's going to say if you've averaged 8.43% for 20 years, does the sequence of gains or losses matter? Let me take you to the far column first. All right? You're going to see that the first year you get hit with a 37% downturn in the marketplace. That has happened before. All right? You don't forget, you also took out $25,000 and they figured in inflation. All of a sudden, that $500,000 account is down to $290,000. All right? Over here, it's a different percentage rate, and you can see what happens. The only difference between these two columns is the sequence of when you gained or lost the money. So in this first column, you gained 32% the first year. In the second column, you gained it the very last year. So compounding of interest has a huge effect on when you lose and when you gain and when you lose money. Okay? So you need to be aware of that and understand that if you take a big hit now, you might not be able to recover. So this is very interesting. The sequence of events reversed in this first column, after 20 years, starting out in the same place, you have $1.5 million. By simply reversing when those gains were made and when they lost, the average is the same. So if you add up all those interest rates, divide it by 20 years, you're going to get 8.43% on both sides of the coin. See, guys, average rate of return is not compounding interest. There's a big difference. They both average the same amount, but they got them at different times. And so, you know, the person that started off and timed it right and got some positive response right away, hey, their account went crazy. They got all kinds of positive room to give back. The person that didn't time it ends up broke for retirement, and it happens very, very quickly. I mean, how quickly did you go from $500,000 to $340? Now, by the way, this is or to 177. This is just we pulled the numbers out of the sky. We just reversed them. This is not indicative of what's happened in the past or what's going to happen in the future. It's just very simple numbers to show you that it matters very much when you lose the money. And as you're going into your retirement danger zone years, do not want market losses. All right? You don't have to have them. It's a big myth that you have to have market losses. It's not true. Bear with me. All right. So what I want to show you guys tonight is how to protect your account balances and make sure you've got enough money to retire and you're going to have enough income. And right now, you either have red money or green money. And red money is any money that can make a lot of money but can also lose a lot of money. That's red. It's called at risk. And sometimes you win and sometimes you lose. And that's a philosophy that's not bad throughout your life, but it gets to be a much worse philosophy as we age. And we get closer to the time that, hey, you know, this asset base is going to have to support me and my family. I don't want to lose. And it's not preordained that I have to lose. That's a big myth. All right? So most people, as they enter their retirement danger zone, have way too much red money and very little green money. What's green money? Green money is the guaranteed money. It could be an old pension that you have that you're going to draw on, hopefully. It could be Social Security. We're going to talk about that and how much you might have and what changes are going to be made to the program. Those are considered pretty green, pretty safe. Anything that's guaranteed by lending institutions, anything that's guaranteed by insurance companies, those are all considered green money. They're very, very, very safe. And traditionally, if you get very, very safe returns, you get very, very low growth. But you know what, folks? That's another myth. You can actually get pretty nice growth and not have any risk whatsoever, and I'm going to share with you how to do that tonight. So I want you to start thinking, if you're thinking about retirement now or within the next 10 years, so you're already in retirement, you really need to start shifting a significant amount of your resources from the red money to the green money. It's time to start shifting, and we can help you with that to determine how much is the proper percentage and so forth and so on. Now, here's an interesting slide. This gentleman's named Harry Dent. Now, Harry Dent, some people think a lot of him as a good market predictor. Some people think he doesn't know what he's talking about. The fact is he's been really right and he's been really wrong both. So why am I bringing up here? Well, Harry Dent and his whole organization spends all their days crunching numbers, population numbers, all kinds of, to say, hey, we think that the market's going to either go up crazy or it's going to go down. And in December of '93, he predicted a great boom. He was off by a little bit, but there was a huge boom over the next 5 years. However, in the early 2000s, he also predicted another boom, and you know what? Went the opposite way. So why do I bring him up? I bring him up to say, look, if this guy and all kinds of other people spend full time, all their efforts, and have teams of people analyzing the stock market to see what it's going to do, and they're only right half of the time, what chance do we have? Why predict the market when you actually don't need to participate in the downsides of it? So just for example, Harry right now is predicting in the next couple of years that stocks plummet 65%. Is he right? I don't know. Is he wrong? I don't know. Neither do you. Frankly, neither does he, even though he's got a lot of, he'll back it up with a lot of facts and figures. He also backed it up with a lot of facts and figures in early 2000 and was totally wrong. All right? So don't try to be a timer of the market. Don't try to outplay the market and I'm going to outguess it, because nobody does. Even the guys that have full-time staffs, they struggle with it. So you do not have to lose any money. When the market turns down, and it will, it's just a matter of time, and how much and how often, you don't have to lose a dime of your retirement money when that happens. And in fact, your retirement income will still grow, and I'll show you how. So there's programs out there, guys, that you have the power to take advantage of market upsides, but never participate in the downsides. Now, of course, that does sound too good to be true, and if you're going to deal in mutual funds and individual stocks, it is too good to be true. That's not how they work. But there are products and programs that are set up that will allow you to participate in most of the market gains, if there are any. But when the market has losses, you don't participate in the losses. And I'm going to show you how powerful that is in real dollars and cents here in a couple slides. You also have the ability to take your IRA or your old 401k, and you have the ability to turn that into a lifetime paycheck machine no matter how long you live. In other words, you have the ability to turn it into a private pension. Now, guys, I know some of you guys on the call still have a pension. Maybe you're still paying into it, or you're collecting on a pension, but they have apps on the way of the 8-track player. There's going to be very few people or companies now that offer pensions. They've almost all gone to the 401k or the IRA route. And the reason for that is the companies were taking it on the chin. They were underfunded. Their pension funds were underfunded. And most of the time, it wasn't because they didn't put enough money in them. It was because the predictions they were given by putting the money in the stock market, by the way, didn't materialize. So the money that they were predicting to pay out pension and guaranteed income streams, they didn't have it. All right, so a lot of them said, hey, enough of this. We're tired of taking it on the chin. We've got to make up these shortfalls every year. Forget that. We're going to switch to 401ks and IRAs. And now, they might give you a little bit of a match. Some companies do, some companies don't. But even if they give you a match, they're not guaranteeing any results. It's totally up to you as to what's going to happen with that account and if it's going to provide income for you. Now, if you don't have an IRA, the product I'm going to talk about tonight will give you tax-deferred growth even though the money's not in the IRA. But it just happens to be a perfect fit if you have IRA money to roll over into this particular account with no taxes, no penalties, and we're going to talk more about that. But even if you don't have an IRA, it's okay. You can still use the product. It does not have to be IRA money. Guys, even when the market goes down, and ladies, even when the market goes down, we can set it up that your retirement income still gets bigger that year. So let's just say you're going to retire in 8 years. We will guarantee that that retirement income will go up every year during the next 8 years, no matter what happens to any kind of stock market. No doubt, we can make sure that your income is going to get bigger for potential retirement every year. All right, so guys, if you can participate in almost all the market ups, never participate in the market downs, why would you do it any other way? Especially when you get to retirement time. Now, I know there's stock traders out there, and there's people that make a living or try to make a living trading stock. Most of those people are not on this call tonight. We're not talking about trading stock. If you want to do that, you can certainly do it with some of your money. However, it's not recommended for your entire nest egg that you work so hard for. I know most of you guys aren't going to do that, maybe a small portion of it. But if you could ride the market ups and never participate in the market downs, you'd be crazy to do it any other way. And I'm going to show you how that's possible and how we're doing that for people all over the country on a weekly basis. The product we're going to use to do this is called a properly designed, you have to underline those two words because most aren't, a properly designed fixed indexed annuity. Gives you a lot of benefits if it's the right annuity. And I'm going to tell you about pros and cons of annuities and everything else. But first let me tell you about what this particular tool would allow you to do. First of all, any money that's put into the account or rolled over into the account will, for most products, will generally be, well, you get a bonus. And it could be as much as 7%. So as an example, you roll over $100,000 into this account, your account balance will start off at $107,000 for that particular example. Now, all products have that. Some do. Some have more bonuses. It just kind of depends on the product you go with. But how nice would it be to roll it over and start off immediately higher than where you're at now and then have a compounding effect from there, all right? You can roll over IRAs and old 401ks in any kind of retirement account. I don't care if it's a Roth. I don't care if it's a SEP. They're all considered qualified plans. And that's why I put you can roll over IRAs and old 401ks and the like. And you can do that tax and penalty free. All right, it's very important to understand that. So if you've got your account right now in mutual funds and it's with Fidelity and it's an IRA and you decide, hey, I want to take all or some of that money and roll it over into this particular account, you can do that and you will not experience any tax or any penalty. All right. Cheryl, I got your question. I will take it at the end. I've got a couple people giving questions. I also had people pre-email me questions. So I do have some of those, and we'll take them up at the end, all right? And we're going to get there shortly. Now, think about this, guys. If your accounts are up right now, and you can get access to that money and roll it over, you're going to lock in those gains, because the fixed index annuity follows indexes, and those indexes are at record highs now. So your money will transfer over at that, and if they continue to go up, guess what? Your money will continue to go up as well. If they go down, your money will not go down. So think about that. You get to lock in this up market we've had the last few years and really lock in it at the top. And if it's not the top, you can ride it even further to the top. And I'm going to show you exactly how that works here in a minute. So you can lock in any gains without experiencing any potential losses. All right, we already talked about you're going to make your retirement income grow regardless of the stock market. I'm going to show you how that's done here in about 2 minutes. And you've got the ability to turn on an income stream from this account whenever you decide to. Some people put in money right away, and they want to start drawing the income right away. That's fine. You can do that. You can also let it hang out a little bit of time and let it grow. And if you can do that, it's very similar to Social Security. The longer you have it, the longer you can let it compound, the more money you're going to have and the more interest they'll pay you. The higher the interest rate is that they'll pay you when you eventually start drawing your income stream. But you're in total control when you want to turn that income stream and when you want to start it. It can be right away. It can be 10 years, 20 years. It all depends on what your situation is. But think about this. Even if you live to be 110 or your spouse lives to be 110 years old, it's very possible, guys, with a traditional account, if you think about that slide I showed you with sequence of returns, it's more than likely you'll probably burn through your cash. I mean, if you retire at, who knows, 65, 70, 75, whatever your figure is, and you live to be 100 years old, more than likely, and probably before you're 100, your cash is going to be gone. You'll have burnt through it. The way this works is you purchase what's called a lifetime income rider. And that lifetime income rider, I'll go over fees and everything else in a minute, but that lifetime income rider guarantees that you will never outlive the money. Even if you live to be 110 and the actual cash that you rolled over into that account a long time ago is actually gone because you spent through it, doesn't matter. They still have to give you your monthly income. So this is truly a lifetime income no matter how long you live for you and your spouse. And that's very different than a traditional 401k or an IRA. And yet, it's better than an old-style pension, because most of the old-style pensions, yes, you got paid, you and your spouse will get paid as long as you live, but if you passed away early, the asset base that created that, the actual money inside the pension, most of the time stayed with the pension fund. Well, this doesn't work that way. If you pass away early and there's still money left in the account, it goes to your estate. So your family still gets your money. Don't think that you're giving it up, you're taking lifetime income and now your family doesn't get any of the money. Nothing could be further from the truth. All right. So I mentioned briefly what an income rider is. I want to show it to you. So here's what I'm going to do. I'm going to pull up a Word document, and I'm going to do some drawing on it. You're going to have to excuse me because I'm using a mouse at the bottom of my computer, and it's going to look like my fourth grade or my third grader did it. But you're going to be able to understand it and see where it goes. All right. So let me pull up a Word doc. Let me grab a marker. And let me show you how this works. Let's use a mythical $100,000. All right, so we take 100K. Well, that's terrible, I know, but doing the best I can. All right, so your $100,000, let's say you put in one of these accounts. You got two sides of the coin. I'm going to draw a line down the middle of the page. You have your cash or your accumulation portion. I'm just going to put CA for cash. And you also have your lifetime income rider. And these are going to act a little bit differently. All right, so it's important to understand that. So when you put in $100,000, let's say just say you used a product that did give you a bonus, and let's say the bonus was 7%. So your cash will start off day one at $107,000. Your lifetime income rider will probably get the same bonus, so that starts off at $107,000 as well. Now, let's just say the first year, there's a lot of different indexes you can follow. It all depends. There's stock indexes, different stock indexes, commodities indexes, dividend-paying stocks. You can choose a lot of different indexes. But for the sake of example, we chose a couple indexes, and that particular year, let's say those indexes went up 8%. All right? Your money will participate about 6.5% of that. It'll depend on the product, but it's going to be somewhere around there. And by the way, that's not the norm. A lot of these programs have caps. The program I'm sharing with you tonight does not have a cap. It has what's called the spread. And the spread in most instances is 1.5%. So meaning, if the market does 8%, you get credited 6.5%. All right, so that's not bad. So the 6.5%, by the way, is on top of the $107,000, not on top of the $100,000. Now next year, let's say the market does what it does, and it goes down 10%. All right, your cash, the $107,000 you started with, plus the 6.5% credit, so what's that, roughly $114,000, give or take. That will roll. That'll go over that year, and it'll stay where it was. You won't gain anything in the cash, but you won't lose anything. Okay, so it slides over with no gains but no losses. Next year, market goes back up 10%. All right, your money will go up about 8.5%. Okay, the spread's about 1.5 points. Next year, market. Let's say the market really has a tough, and it goes down 18%. Your cash, all the accumulation that you've gotten to now, it all stays with you, and you'll move over and won't lose any money, but you won't gain any money. So guys, if you follow charts, if you've ever looked at charts on stock, you start to see this looks like a stair step. Some years you're going to make money, and other times you're going to keep even. You're not going to go backwards, and that becomes important. I'll prove that to you here in a minute. So this is what your cash or your accumulation is doing. Meanwhile, your lifetime income rider acts a little bit differently. And this will depend on the product that you buy, that you invest in. Some will just have a straight out 6% compounding, no matter what the market does. Some might guarantee you a lesser amount in the guarantee, but they might give you a portion of the index as well in the up years. So let's continue with this example over here. Let's say the first year you take a product that guarantees you 4% minimum growth, no matter what the stock market does, and that year you also get credited the 6.5%. So your income rider that particular year went up 10.5%. Okay? Next year in our example, remember, the market went down 10%. Our cash stood over, didn't make anything, didn't lose anything, but our lifetime income rider still went up by 4% that year. You still got your minimum 4. Next year, market went up 10. You get your 4 in the lifetime income rider plus your 8.5. So that particular year, your lifetime income rider did 12.5%. All right? So the worst your lifetime income rider can do is 4%. So you can start to see a graph take place. Over here, we've got the stair step for our actual cash. Our lifetime income rider is compounding. It's compounding in different amounts, depending on what happens in the market. Or there are some products that just have a 6 or 7% compounding straight up. You don't participate in any index, but you get a guarantee of the lifetime income. That's going to depend on the individual client and really what they're looking for. But you guys get the point. So let's just say you did this for 10 years, and let's just say your cash ended up at, let's say your cash doubled in 10 years. It might not. It's not going to go backwards. We know that. How much it's going to go up is going to be very dependent on a particular market. But let's say our lifetime income rider, the figure over on this side was $280,000. Now that doesn't mean you can take out $280,000 in cash. Remember, this is your cash portion. You could take out the $200 if you wanted to. But instead of doing that, let's say you decide to tap your lifetime income rider, and depending on your age, they'll give you anywhere between 5 and 7%. Usually 5% was the age when most people decide to tap it. So if they're going to give you 5% lifetime income, no matter how long you live, would you rather get paid 5% of $280,000 or 5% of $200,000? Of course, we all want the higher figure. So this is what the lifetime income rider does. It ends up at a higher figure than your actual cash, which is a good thing because we're setting this up for income. Folks, if you think about successful retirees that you've known in the past, I've known a lot of them, as I'm sure you have, and they had similar things in common. The one thing is they usually had very little debt. They might have had a small mortgage, but it wasn't much. It was certainly very low in relation to their overall income. A lot of their hot real estate is free and clear, and they have stable, predictable income. It might not be a fortune, but it's several $1,000s a month that comes in no matter what, and some of that's with Social Security, some of it's with a pension, Some of it's with a retirement account. But they have steady income that they can count on, and that's how you live a successful retirement, not wondering if the money's going to be there. So, again, this is your cash side. You see the stair step. The stair step never goes backwards. So in any of these years, you have a serious correction of 30%. What would happen? Well, whatever your money was that particular year would slide over, wouldn't lose any, wouldn't gain any, and your income rider would still go up somewhere between 4 and 7% depending on the product. Okay? So that's what an income rider is. That's how it works. Let me minimize that. Whoop, let me get rid of erase all drawings. All right, let me get back to the big slide. And we're back. So there's the example of how your income rider works, and it works differently than your cash, but your cash is protected, can't go backwards. Now, here's the power of an annual reset, which is what I just described to you. This really looks kind of complicated, but it's really not. It's actually very simple. We took some real-life numbers, all right? These are really, real-life numbers starting back in 1999, all right, and going all the way till the end of 2013. So let's say you took that same $100,000 we were talking about and you put it in the market. And remember, the market's very much a creature of timing. And you put it in, you thought the market was going to go crazy, it was going to be booming. You read Harry Dent's book, and he predicted, hey, the beginning 2000s are going to just rock. Well, a lot of things happened. We had a dot-com bubble burst. That happened the first year. We had, of course, the World Trade Center attacks and terrorism. And so, guys, those first 3 years, your $100,000 was now down to $60,000, just a little under 60. All right? Now, market came back up. It's at a low. People are worried, but all of a sudden, people start coming back in. People think, and now it's going up every year. Bam, 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 bam. But guys, all the way to 2007, you still don't have your $100,000 back. You're right at about $100,000, 99 and change. So we'll say you're even in 2007. And we all know what happened in 2007. It was disastrous. And in 2007, 2008, all of a sudden, you lost another 40% of your money. Now, ever since then, things have been coming back. We got 75, 8, 85. The money's coming back. So this is what actual money in an investment inside the stock market would have done, tracking an index. That's the S&P 500 index. So right here's your guide. That's the S&P 500 index. Now, the fixed index annuity I just described to you, your accumulation value is your cash side, what I mapped out for you on the Word doc. So in that product, you put in the same 100, you mistimed it, market tanked 3 years in a row. What happened to your 100,000? It rolled over. Now you got a bonus, so you probably got 107,000. So you got 107, 107, 107. But this is just showing the 100,000. All right. Next, the market started to go up, and you participated in it. Now this has you participating at 5%. But the market went up and up and up, and we got to 2007, and your $100,000 is very safely and securely, with no risk, climbed up to about 123.5. And then disaster strikes. 2007, 2008. 40% of your capital is lost here. Your money that you've already accumulated rolls over and resets. Next year, the market starts to go back up, and look what starts to happen to your money. It goes up. Oh, market took another dip where it was stayed even. You stayed even. So now you get to the end of 2013, and by pure luck, the market has come back to, let's say, $126,000. All right, pure luck. Guys, with inside that fixed index annuity, you've got over $150,000. So you're $25,000 to the good. And by the way, what if the next year it would have dropped another 30%? How much more to the good would you be? All right. So no matter what, even in that haywire market, and people say, oh, we have record high markets. You know what? A solid fixed index annuity with no downside. Guess what it did? It outperformed that market. Now, the other thing I want to point out, this is your income rider. Now, this has straight compounding at 6%. You started off with your 100, and this is what happens every year. No matter what, ups, downs, you got compounding. So the money reset, 6% on top of that. Reset, 6% on top of that. So you're compounding your money. And at the end of 2013, your lifetime income rider has $226,000. So, folks, that's basically an extra $80,000 of money you have in there. Now, if they're going to start drawing an income stream from it and they give you 5%, they're going to give you 5% of the $226,000. So if you're getting set up for retirement, and you would have done this back then, would you prefer 5% of $125,000 or 5% of $150,000, or how about 5% of $226,000? This can absolutely be done, and we're doing it for clients all over the country. We'd love to help you and your family with this. By the way, this isn't any specific product. This is just, hey, this is if it happened with a fixed indexed annuity and these were what the product had. By the way, the numbers I'm showing you aren't even a fantastic fixed indexed annuity. It's just kind of humdrum fixed indexed annuity. We actually have some products that would do better than this. All right. So that's the power of never losing any money. See, guys, if you go back here when you're in 2002, you lost 40% of your capital. You know, that doesn't come back overnight. And it didn't. It took 1, 2, 3, 4, another 5 years till you were even, and then what? You got hit with something again. Now, I want you to picture this year was your retirement year. Well, your retirement probably changed if you invested here. Or this year, boy, 2007 and 8, I got my money back. I'm retiring. You're still in mutual funds. Bam. You lost another 40%. That's never happened when your money was in the fixed indexed annuity and your lifetime income rider went up every year without fail. Okay? Let me do this. All right, so let's talk about some negatives. Now, a lot of people say this is too good to be true. No, it's absolutely true, but as my dad said, you know, my dad was a very wise man. He was a Detroit police officer, and he grew up in the hills of Pennsylvania, so very simple family, but he had a saying. He said, son, it's not always beer and Skittles. So there's always a downside to everything. So what's the downside? You do not want to put any money inside of any annuity, no matter what it is, fixed index annuity or any other annuity, if you're going to want the bulk of that money in the next 5 to 10 years. All right? It's not a place to put short-term money. It's a place to put longer-term money that you want to use to retire on. Because if you, let's just say you put the money in, and 5 years from now you need it all out. And let's just say it's done well, you know, it's up to 130 grand, whatever it is, and you take it all out, there will be a penalty for early withdrawal for anything above the first 10%. So any year you need to, you can take out 10% of the account balance without any penalties whatsoever. But anything above that 10%, as far as a capital withdrawal, you would be penalized. And the penalties will start, it depends on the product, high in the early years, you know, 10, 12% in the early years, to usually go down to 0 after 10 years. And in the last few years, it might be 3, 4%. So if you know you're going to, you know, you got a chunk of money, but you're going to be building a house in the next 2 years, you don't want to put it inside a fixed index annuity. There's other products we can put it in that will have it liquid and protect it. There's other things we can do with it, but this wouldn't be that particular product. But if you've got IRA money or long-term capital that you want to set it and forget it, and you want to know it's going to be there and know it's going to provide lifelong income and know it's not going to go down in the next market crash, and you've got other money that you can tap into for emergencies, and by the way, we would verify that. We would never put anybody in this product unless we knew they had other liquid money. So as an example, if you had was your last $100,000, we're not putting $100,000 into a fixed indexed annuity. It doesn't make sense. You're going to probably need more of that money out, and we don't want to see you pay penalties. But let's put penalties in perspective for a minute. You know, people always say, well, I don't want to pay penalties on my money, and I understand that. I don't want to pay penalties either. And yet, let's just say it was 3 years from now, you had to take all the money out for whatever reason, something happened, and you needed the money, and you got hit with an 8% penalty, all right? Well, you'll gripe about that, but we'll think nothing about leaving it in there in the market for 3 years. The market goes down 25%, and then we got to take the money out. We'll think nothing about that. That's not a penalty, per se, but it really is. It's a huge penalty. So the worst case scenario, you've got to liquidate everything in 5 years. Yes, you're going to pay a penalty, but you still mitigated any downside loss to a bare minimum. But ideally, we don't want you to have any penalty. So this is going to be longer-term money that you say, hey, you know what, John, I like this. I need to make sure I'm going to have X number of dollars a month. I've got some seed capital that can do that, and this sounds good to me. I want to know more, all right? So, again, I already talked about it, but let's say you put the $100,000 in there, and the first year, for whatever reason, you decide, you know what, I need $9,000 out of that account. You can take the $9,000 out. There'll be no penalty whatsoever from the life insurance carrier that sets this up. Anything below 10% or below, penalty-free, and you can do that every year if you want to. But keep in mind, when you do that, that will, of course, reduce the lifetime income amount that you eventually take. So, guys, this is money that I call it set it and forget it money. Market goes up, I'm going to participate in most of it. Market goes down, I don't lose a nickel. Let me go continue to do my job, make sure this money is going to be there, and make sure I can retire. This is set it and forget it money, all right? Now, let's talk about fees, because one of the downsides of annuities is fees, and fees are all over the place. Most of your variable annuities that have for almost no guarantees, they're kind of like running a mutual fund inside of an annuity. Those are generally going to have much higher fees, okay? So what are your fees? It depends on what product you go with, but that income rider I described to you is going to be anywhere between 3/4 of a point and 1 point annually, okay? So 1 percentage point. Let's say it's 1 percentage point for round numbers. So for the $100,000, you'll pay $1,000 a year for for that lifetime income rider. Okay? So I don't know about you guys. I just have to look at things realistically. I understand that if I'm out there doing business in any way, shape, or form in any arena, if people are doing business with me, they're making money. Everyone's got to make money. If they're doing it as a business, as a profession, everyone's making money. I'm okay with that. But I always want to know, what am I getting for my money? You know, what are my fees getting me? Well, guys, in this particular instance, your fees are getting you no downsides. Your money can't go backwards. It's getting you a compounded minimum lifetime annual income rider. It's getting you the market when it goes up, but not when it goes down. To me, I'll pay a little bit of fee for that. I think that has tremendous value. I'm not going to pay. I've seen annuities, guys, with as high as 5 and 6% fees, and they're usually variable annuities, because inside those variable annuities, there's money being traded. You know, they're trading a lot of times. It's not an index. They do have index products there too, but a lot of them are just basically money in cash accounts, and money gets traded. Well, guys, those trades cause commissions, and those commissions get passed on. I see some really high fees. So if you do have an existing annuity and you kind of want to know, hey, is this a good one or a bad one, I'm happy to do a side-by-side comparison for you. And if we've got something better, I'll tell you that. And if we don't, I'll tell you that as well. But I'll be able to show it to you in real dollars and cents, because there is such a thing called a 1035 exchange that allows you to exchange out of both life insurance policies and annuity contracts into a product that you feel is going to be a better fit for you. So even if you got your money inside one of those things and you haven't been happy with it, but you don't know what to do with it, reach out to us, because maybe we can help you, get into something like this that's not going to have the downsides and certainly not going to have the fees. The other fee in that product I mentioned to you, remember the spread. All right. So in the years when the money goes up, if the money went up 8% and you only got credited 6.5 of it, the other 1.5 is going to the insurance carrier. So that's technically a fee, but that's coming out of profits, and I get to participate in most of the up. And the next year, when the market goes down, I don't have to pay. There's no spread to pay. Okay, so that's only in up years am I paying that. So for me, I think it's tremendous value, tremendous place to grow and protect money, and at reasonable fees. We'll make money. Okay, so what do you get for money? We talked about that. Also, guys, in some of these products, remember we talked about at the beginning, long-term care or home health care. A lot of these products have built into them that with your 1% fee, let's just say it is a 1% fee for your income rider, you have what's called a home health care doubler. So as an example, let's say you had the money in there for 10 years, you had $300,000 in your income rider, and you start taking out your, let's say 5% of 300 grand, you start taking out $15,000 a year guaranteed for the rest of your life. Yes, you can take out more in years if you need to, but you start off taking the 5%. Well, if you should need home health care, someone to come in and help you do things as we age, let's face it, that's a fact for a lot of people. If that should happen to you, you can actually take double the amount of lifetime income. So if it was $15,000 a year in that example, you could take $30,000 a year for up to 5 years and use that extra money to defray some of your costs to help people come in, even if it's a family member. If a family member is helping you in those times, they might be taking off work. It's probably costing them money. You want to be able to pay them. You're going to be able to do that, and that's all included in that same fee. So, when I have market protection, compounding growth, the chance to ride the market ups with not the downs, and if I need home health care, I can use it for that. I think it's tremendous value. There's a lot of value there for the fees that you're paying. Also, there's some people on this call that, and once in a while I have a client that says, John, I know I've got enough income, and I'm going to be fine. I've got this much Social Security, I get this much pension, I've got some other money, but boy, I'd like to leave some more money behind for my kids, but I'm too old to get a life insurance policy or any kind of significant life insurance policy. You don't want to get an end-of-life policy if you don't have to. Those are very expensive, but I'd like to leave something behind. Well, you can take that same $100,000, put it in that same fixed index annuity, and you can add what we call a death benefit rider on there. You can't do an income rider and a death benefit, but you could do a death benefit rider that when you pass away, and that death benefit rider says $200,000, that's the payout that goes to your family. So you can even use these products to increase your estate. That's not most of my clients don't want to do that, but there are some that say, I've got enough income, I'd like to leave some more money behind for my kids. Will this help? And the answer is absolutely. We can put a rider on it that's a death benefit rider. You're not qualifying for it physically, so there's no health exams, anything like that, and tremendous. So that's the kind of stuff that you get for the fees. So yes, there are fees in annuities. Like anything else, there's always some truth in a myth. And so I've seen some annuity products that are terrible. They go down with the market. You've got high fees. Why to have your money there, I don't know. But people do put their money there. None of that exists in this particular product if we do it right, and we do it right. This is what we do all over the country. So we are coming to the end of this. I told you I'd keep you between 45 minutes and an hour, and by Jove, that's where we're at. So let me tell you, what I'd like to do for you. And there's no charge for this. I'd like to build you an income plan. But I need a little bit of information if I'm going to be able to build you out an income plan to show you how much lifelong income you would have, when you would start it, how much you'd have, how much it'll last, how long it'll last for, all that stuff. So for those of you guys that are interested, there's no obligation for it. I'm going to have you do a couple things. First of all, have your pen out, and I hope you're writing some stuff down. The first website you see there, jjpws.com, jjpws. Let me take you to that. I think I can here. And let me show you what you're going to see. All right. Let me take you there. And it's just a one-page form, guys. Whoop, not available. Don't tell me that. Ah, there it goes. It's loaded. Okay. So here's what I put up here, guys. This is hidden on the main site. Nobody else can see this but you if you've been on this particular webinar. So that's why I go to JJPWS. It'll redirect you right to this page, and it's very simple. I just need your name, email address, a phone number to contact you. Give me best date and time to contact you at. Give me a couple different times if you can. Say, John, I'd like to see what an illustration looks like with one of these fixed indexed annuities, and I've got X number of dollars. Tell me the amount of money that you're considering. It doesn't have to tell me all of it, but give me something so I can at least have something to work with to show you a baseline. We can always add or subtract from the particular illustration later. Then I need to know, are the funds qualified? In other words, is this IRA money you're using? Or is it non-IRA money? You've got some just investment capital or money in the bank doing nothing. If you've got money in the bank or investment capital and it's not tax protected inside of an IRA, guys, these fixed indexed annuities, the money compounds tax deferred even if it's not in an IRA. So if you've got some money sitting in the bank or you're in a little riskier stock investments and you're tired of that, you want to gear for retirement, we can still do it. We just need to know if it's qualified or not qualified money. I need to know what state you're in. Okay, your date of birth, because I need that to run an illustration. And that's all I need, guys. Give me that and submit it. And give me a couple days. Tomorrow's already Friday, so give me first part of next week, and I'll reach back out. I will send you an email to confirm I have it, so you know it's not lost out in cyberspace. And if you send me one and I don't send you, or me or my assistant Colleen doesn't send you that we have it, then we don't have it. And reach back out to us. You guys all have you got emails from me. You can use those emails. So when I get it, I'll reply that we have it, and then give us a couple days, and we'll work on it. All right. So that's one thing. I want to build that for you, but I also like to do something else. And I'd like you to do just a little bit of homework. And a lot of people don't even know this exists. If you take that long website right there, I had to do that. That's the direct website to the Social Security website that will predict for you, and it's not guaranteed, but it'll predict for you. Give it the Social Security number that you have in your name, and it'll tell you how much Social Security money you're going to be able to pull out. And right on there, guys, they tell you that up after 2033, I think they tell you, whatever figure they show you, if you're going to retire after that, you're going to get 77% of whatever they tell you. That's based on today's dollars if they don't do something with Social Security. We know they will. We just don't know what. We don't know when. I'm pretty confident Social Security is going to be around, especially for people that are going to retire in the next 10, 15 years, 20 years. And I think it'll be around even for guys like me that maybe I'm retiring a little bit after that. But I think they're going to have to change it. So I don't know that those numbers are going to be totally accurate. But we can only play the cards we're dealt today. So what I would tell you is go to that site, write it down, okay, and put it in there and tell me how much they're telling you. So we'll have a ballpark what you're going to get from Social Security. We can take a look at some other assets and how we might be able to reallocate those. I'll show you an illustration on a couple really solid fixed index annuities, depending on what your goals are. All right, and I'll be able to show you how much lifetime income, how much green money you can set your watch by. All right. And that's, man, you sleep good at night just knowing that you're going to have enough income, and you're going to be able to have that income for the rest of your life. All right? A couple other points. Follow us on Facebook, guys. We put out a lot of material. Hopefully you guys saw that case study. I emailed you guys a case study of a client that we had, and we looked at their entire picture and really structured some neat stuff for them. That's obviously more intricate than we're talking about tonight, but I didn't want to have a 3-hour webinar. That's not good for anybody. It's not good for me. It's not good for you guys. I just wanted to have 45 minutes or an hour and give you some financial concepts, show you a product or two that will work, that it's a phenomenal product, but we're going to have some new stuff, some new trainings coming up. And I always want to let people know I'm always releasing video, content, articles like crazy. So for all you Facebook users, go to Facebook/Perpetual Wealth Systems and like the page, and we'll keep in contact with you. A lot of you guys are already on my email list because that's how you're here. Some of you guys aren't. A lot of people came on from social media or someone referred you to this, which is fantastic. If you want to go to anywhere on our site, go to theperpetualwealthsystem.com, and you can watch a presentation there. You can get a free download at the video of the week, and you'll automatically be put in our system. And we don't hound people with emails. We We put out a lot of content. We sell very little as far as products and anything on there. It's almost always content, education, and I think you'll enjoy being a part of it. If you'd like to reach out to us, you can either send me an email directly, John, John, at theperpetualwealthsystem.com, John at theperpetualwealthsystem.com, or info at theperpetualwealthsystem.com. That will go to my assistant, info at theperpetualwealthsystem.com. And you're also free, call us up directly. We are on East Coast time. Even though I'm in Detroit, that's East Coast time. And we're usually there 9 a.m. to 5 p.m. Eastern. Phone number's right there, 586-944-0794. But as soon as we're off this call, some of you, in fact, I've already got 2. So I know you guys are already on there doing it, but that's great. Go to JJPWS, John Jamieson Perpetual Wealth System. That's what that stands for, JJPWS.com. Fill that out. Give that little bit of information. We'll reach back out to you, and we look forward to working with you and doing the best we can for you and your family. I think you'll like to work with us. Here's some book covers. If you guys haven't got the Perpetual Wealth System, feel free to order it. You'll find it at my site. Wealth Without Stocks, I'm hoping to have it out in about 90 days. It's going to be just loaded with great information. This information will be on there along with tons of other stuff. Frankly, there's going to be no other book like it on the market, and I'm really excited about it. But actually, the Wealth Without Stocks domain name isn't even active yet. The site's almost ready to launch, so don't even go to that one yet. But we will be using it a lot once we launch the site. But go to theperpetualwealthsystem.com, and I think that's going to cover it. Let me see if we got some questions. We did have a question I know I saw earlier about can you use a public pension? And the answer is, or a public account, a government account. The answer is you can roll those over if you have access to it. So in other words, if it's an old account that you have to do something with, you're going to be retiring, yes, we can certainly roll that money over. If it's active right now and you're paying into it and the government's paying into it for you, you're not going to have access to it unless you're 59 and a half or older. And of course, I don't know all that, but you can feel free to send me an email, tell me your exact situation, and we'll see if you can access that money. You can eventually. I just don't know if you can today because I don't know enough about your situation. All right, so let me see what else we have here. Bear with me. We're just going to take some questions. Here's one. Once the annuity is set up, can you add to the principal? You absolutely can. Thank you for the question, Sharon. Any money that's put in the first year, by the way, you still get the bonus on. So if you do go into a product that you're going to get, let's say, a 7% bonus, and in fact, I just had a client do this today. They wanted to put in money for their SEP contribution. We had rolled over their SEP into this product. They're going to put $40,000 in it. They're going to get the bonus. So they're going to get an additional $3,000 basically. Anything you do in the first year, you'll get the bonus. You can add to it after that all you want. You just won't get that initial bonus that you get in the first 12 months. What they do with that, Sharon, is annuities are annual things. So they're crediting interest on an annual basis. So let's just say it's halfway through your crediting period and you put in $10,000. What they'll do is they'll take that $10,000, they'll put it in a fixed account, get you very little bit of interest. I think the fixed account right now is about 1.5 points. But they'll hold that for 6 months, okay? And then they'll put that into whatever indexes you tell them you want to follow. And that's something we would talk about. What indexes do you like? What don't you like? What we think has the most potential. So yes, you can add money to it after the fact. So thanks for that question. We got some other ones, so bear with me. Bear with me, hang on. Okay. That's a great question. Does the lifetime income balance keep accruing in years that you take a distribution? Okay. Here's the way this works on distribution. When you tap your lifetime income rider, the rider stops growing at that point. So let's say you put your 100 in, it's a few years later, you've got 200 in there, and you're taking 5% out a year, okay? That particular portion of the annuity will stop to grow, so you get what you get. Now, there are some actually products that have cost of living increases. That all depends on the client and what they want to do. But for the most part, that money will, the lifetime income rider will stop compounding, but your money will still perform. So the first year you take a drawdown, if the index does really well, your money's still going to go up that year. So your cash will still do what it does, even when you start taking the money out. But your lifetime income rider will stop when you start accessing that money. Okay? Hope that helps. Let's see what else we have here. We already talked about the public employees. We talked about that. Guys, if you have any questions, shoot them. I'm going to answer them here for about the next 10 minutes. Hi, John. Is there any training I can receive to offer this product to potential clients? Email me directly. We won't take any time on that tonight, but email me directly. I'd be happy to talk to you about that. Another one. Are there minimums and maximums? There are. It depends on the product. Most minimums are initial contributions. Most products are $10,000. Some are more. And maximums, you can get millions of dollars in these things, guys. You can put $1 million in, $2 million. You could put $1 million. I've done this before. $1 million with the husband and $1 million on one with the wife. So you can get an incredible amount of money inside of these. So the minimums are going to be usually about $10,000. That's the initial. And then moving forward, it depends on the product. So if you want to contribute to it annually, usually there's about a $1,000 minimum on most of them. Some of them might have a $5,000, but you can get a lot of money in these things. Okay, and the minimums are very reasonable. Let me see what else we have here. Are there penalties from my IRA if I switch it over? No, because a fixed index annuity is considered a qualified account. So you're not going to be withdrawing your money and then putting it in here. We're going to be exchanging it, and we do all that for you guys. So basically we take the application from you once we've got all the, your education complete, you're rock solid with it, you really want to do it, you've got your numbers. We take your application, and then the host company handles transferring the money. So you didn't have to even talk to the rep where you got your money at now. We'll handle all the transfer for you. But because you're doing a transfer from an IRA, you're going from a qualified account to another qualified account. So there's no penalties or taxes. So that's why it's a great place for IRA money. Let me see. Can you show the cash versus income rider again? Oh, I know. The drawing I did on the Word doc, I can do that. We still got almost everybody that started on the call is here, so I'm going to assume you won't mind if I pull this out. It won't take long. Let me go like this. 1 second. Let me pull up this Word doc again. Let me pull out my handy trusty pen, and I'll go through this real quick with you. Let's put the line down the middle. This is what your cash will do. This is what your lifetime income will do. Again, I apologize for the writing. So we put $100,000 in to start as an example, right? Round numbers, it's easy. Let's say we do get a bonus in a particular product and we start off with $7,000. Okay, lifetime income rider, let's say we get the same bonus. We start off at $107,000. Now we're going to track different indexes. You're going to be able to pick some really solid indexes. It's whatever you're comfortable with. But let's just say as an aggregate, the first year, indexes go up 7%. Your 107 will go up about 5.5%. And that will depend on the index and the product and so forth. But you get the point. You're going to get most of the upside. All right. Next year, the market goes down 9%. All right. Your original 107 plus your 5.5% credit goes over and does not lose but doesn't gain. No market loss. Next year, market goes crazy. Let's say it goes up 14%. It's going to be 14 if I have anything to say about it. Let me see, 14%. All right. Your cash is going to go up about 12.5 that particular year. So it's always either moving forward or staying even. There is no going backwards. So no more having to make up 20, 30, 40% market losses. Now, at the same time, your income rider is going to act a little bit differently. Your income rider might start off at 107 as well. Let's say that first year it went up, you got credited for 5.5. You'll get another, let's say, 4% on top of that if that's the guarantee roll-up. So your first year, your income rider went up 9.5. Next year, market went down 9%. Your income rider, your 107, plus the 9.5% on the 107, say another 10, so let's say it's 117,000. That moves gets compounded by 4%. So even in the dead terrible years. Next year, market went up like crazy. You got credited 12.5. You're actually going to get credited 16.5 that year. That's not going to happen often, guys. I don't want to paint any ridiculous rosy pictures for you, but that does happen sometimes. So in those years, you're going to participate in most of those ups, but never participate in the downs. Okay? So I hope that helps. Let's see if we have any more questions. We're going to wrap up. We're just at a little past an hour. I got my my presentation in less than an hour. Now I'm just handling some questions. So let me see if we have any more. If you have any, now's the time. Shoot them over. Let me see. Okay, I'm assuming that the accumulation value goes down with each distribution. Sometimes it does and sometimes it doesn't. It will depend on what the index did that year. So let's use a real simple example. If you took out 5% that particular year and you got credited 5% of cash in the index, your cash will stay the same that year. Okay? So you remember, even when you start taking distributions, your cash is still moving forward. So in a year that it stayed flat, it would go down that year based on the distribution. All right, not on any market losses. So some years it would go down if you take money out during the down years when there's, again, not down for this, but you would roll over and stay even. But if you took $10,000 out, well then yes, your cash account would go by $10,000. All right. Hope I made that clear. If not, reach out to me again. We'll get it straight. Guys, I think that's it. If I don't see any other questions, we talked about that one. We got that one. We talked about that. Okay, we talked about that. Hold on, make sure I got them all. The rest is all technical stuff. All right, guys, listen, it's been my pleasure. I want to thank you for coming out tonight on the webinar. It's such a great way to distribute information. I hope you guys liked it. Oh, hold on, we got one more if you guys want to stay on for it. Would it be fair the average fee with spread would be about 2.5%? With the spread, yes. Otherwise, you're really just paying, for the most part, for your income rider. Okay, and again, that's going to depend on the product as well. But you're right, you're in that range, sure. You're going to have a 1.5, 1.75 spread depending on the index, and then you're going to have your income rider that you're going to pay for. So yeah, you're pretty close. I think that's going to cover it, guys. It's been my pleasure. Reach out to me. You got all my contact information. Fill out the illustration paperwork. We'll get some numbers over to you. I won't reply to you tonight because it's getting late, and I want to spend some family time as well. But whatever I have tomorrow, I will email you, or my assistant, Colleen, will email you, let you know we have it, and that we're working on it. And then we'll be back in contact, and hopefully we can work together. I'm looking forward to it. I hope you guys have enjoyed this training. We're going to be doing more, so keep your email open. We're going to cover all kinds of cool different topics I think you guys will enjoy, and it's been my pleasure. So with that being said, let's wrap it up. Go spend the rest of the time with your family, and we'll talk to you soon. Thanks so much.